Traders love their catchphrases. The trend is your friend. Let your profits run. Buy low, sell high. It sounds so simple, but when you actually sit down to trade, you hit a wall almost immediately. How high is high? Why sell if a trend is still going up? The indicators you rely on constantly contradict each other, leaving you paralyzed. The core problem goes deeper than different indicators disagreeing. A single asset can tell you completely opposite stories at the exact same time, depending entirely on the time frame you look at. Look at these two charts tracking the exact same asset. On the left, the daily chart shows a clear, profitable upward trend. Switch to the hourly chart on the right, and that exact same average shows a steep downward plunge. To resolve this, Dr. Alexander Elder developed the triple screen trading system. It acts as a multi-layered filtering mechanism designed strictly to strip away this conflicting timeframe noise. If you enter the market without a system to reconcile these opposing signals, you aren't executing a strategy. You are simply guessing, and guessing in the financial markets is mathematically indistinguishable from gambling. We start with screen 1, the tide. This chart shows a long-term momentum indicator, like a weekly MACD histogram, designed specifically to identify the overarching, slow-moving macro trend of the market. This screen establishes an absolute rule. You must only ever execute trades that align in the exact same direction as this long-term momentum. If the macro tide is rising, you only look for opportunities to buy. Once the direction is locked, we move down a time frame to screen 2, the wave. Here, you are searching for short-term price movements that go precisely against the main tide we just established. You're looking for dips in an uptrend or rallies in a downtrend. Think of a dog on a leash out for a walk. The owner's steady walking path is the macro tide. The dog might dart off to the side, pulling the leash taut. But eventually, that micro counter trend reaches its limit and is mechanically bound to snap back and revert to the owner's direction. By intentionally locating one of these micro recessions within a macro trend, you create the highest probability zone for a successful trade entry. You take the market's chaotic noise and turn it into a tactical advantage. Now we hit the final screen, the ripple. This third screen is an intraday technique used to time the exact execution point of your trade. This chart demonstrates a trailing buy stop. If the first two screens say it's time to buy, you place an order exactly one tick above the high of the previous day's candle. You only buy if the price actually hits that line, mathematically confirming the momentum has reversed in your favor. When that trigger is hit, the triple screen system has done its job. It has filtered out the chaos and isolated a pristine, high-probability trading opportunity. But right at this exact moment, armed with a perfectly filtered entry point, most amateur traders will proceed to completely destroy their accounts. Locating the perfect entry point means nothing if you lack a rigid mathematical framework for survival, because eventually a trade will inevitably turn against you. A professional trader structures their entire approach around a strict hierarchy of priorities. High returns are actually last on the list. Steady returns come second. First, above everything else, is sheer survival. That survival is dictated by a foundational mathematical law. You must never risk more than 2% of your total equity on any single transaction. Here is a visual breakdown of how this limits you. Let's start with a $10,000 trading account. Following the 2% rule, we isolate our maximum risk pool. For this account, you are allowed to risk exactly $200 on your next trade. Now, let's assume you find a stock trading at $100 per share. To protect yourself, you place a stop loss at 90, which will automatically sell your position if the price drops. The difference between your entry and your exit creates a strict $10 risk per individual share. To find your exact volume constraint, divide your $200 risk pool by that $10 risk per share. The math gives you an undeniable limit. You can purchase exactly 20 shares, not a single share more. Once that trade is live, there is a golden operational rule for your stop loss. You may only move it forward in the direction of the trade to lock in profits. You never, ever move it backwards to accommodate a losing position. This strict mathematical architecture serves a highly specific psychological purpose. It completely removes your ego, your hope, and your fear from the equation. turning your trading into a cold, mechanical system of self-preservation. Building a sustainable career rests on three interconnected pillars. You must master your own psychology, conduct systemic market analysis, and strictly adhere to money management. True trading mastery isn't about perfectly predicting the chaos of the market. It's about using logical filters to cut through the noise and applying unforgiving math to ensure you always survive to trade another day. Imagine a chronic dieter. They understand the mechanics of weight loss. They know exactly how calories work. Yet time and again, the distant promise of long-term health is derailed by the immediate temptation of a short-term indulgence. This behavioral flaw maps perfectly onto the financial markets. Most traders enter the arena with a logical strategy, but quickly abandon their discipline for the sudden dopamine hit of a risky, impulsive bet. They state they want to build wealth slowly and methodically. However, their actual daily choices reveal a subconscious desire to treat the market like a casino, chasing the thrill of the gamble over the execution of a plan. It's one thing to deceive others, but deceiving yourself guarantees failure. If you cannot override that inner saboteur, no amount of capital or technical knowledge will yield long-term success. To survive, abandon the search for a magic formula and engineer a rigid system. It rests on three interdependent pillars: psychology, market analysis, and money management. Remove a single component, and the entire structure collapses under the market's pressure. Let's examine the first pillar, psychology. Before you run any mechanical strategy, you must establish emotional control over the operator. That starts with ruthless realism. If you are starting with $10,000, you cannot mathematically expect that account to replace a full-time salary. Demanding impossible returns forces you to take catastrophic risks. You also need an objective record of your logic. Keeping a precise physical diary of every trade, including charts and written reasons for entering, forces you to look at your past mistakes without the filter of selective memory. The moment you start counting paper profits mid-trade, you lose objectivity. Translating unearned, unrealized gains into things you plan to buy clouds your analytical judgment with greed. Without these stripped emotional restraints firmly in place, your inner saboteur will bypass every logical safeguard you've built, driving the account straight to zero. Once the operator is secure, we move to the second pillar, market analysis. This acts as your system's radar, helping you navigate chaotic price action without blindly trusting a single isolated data point. This animation illustrates a reliable way to separate long-term momentum from short-term noise. Think of price movement like a man out walking his dog. The straight, steady line represents the man. In the market, this is your trend-following indicator, establishing the primary reliable direction of the asset over time. The rapidly moving wavy line is the dog, representing an oscillator. It runs erratically back and forth, but it is mathematically restricted by its leash from deviating too far from that main trend before snapping back. To tighten the accuracy of this radar, you structure these tools using exponential averages. This specific mathematical calculation forces the system to assign more weight to recent price data, preventing old information from dragging down your response time. You also scale up. The wider your time frame, the stronger the signal. A weekly chart will consistently provide a heavier, more reliable structural reading than a daily or hourly chart. Ultimately, successful market analysis does not predict the future. It simply measures the current dominant forces of a trend to identify the safest possible point of entry. Even with flawless analysis, you will be wrong. That brings us to the third pillar, money management. This is your system's absolute fail-safe against the mathematical inevitability of loss. Traders who ignore strict risk limits face the exact same probabilities as a gambler fighting a casino. If you bet too much, eventually the house edge will consume your capital. You can have perfect emotional control and an incredibly accurate market radar, but a brief, statistically normal string of consecutive losses will easily shatter an unprotected account. Money management dictates your sizing and your stops. It acts as the defensive perimeter, ensuring you remain solvent long enough for your analytical edge to generate actual returns over time. These three components operate strictly as a single unit. Exceptional market analysis holds absolutely zero value if it is paired with reckless money management. Conversely, The most rigid risk rules in the world cannot save an operator whose emotional instability causes them to override their own execution protocols. The technical blueprints for trading are universally accessible. The rules are public, the indicators are free, and yet long-term survival in the markets remains incredibly rare. Engineering a profitable trading system requires a dual focus. It demands dedicating exactly as much time and severe scrutiny to analyzing your own psychological flaws as you do to analyzing the financial charts.